Good morning, ladies and gentlemen. Morning, morning, morning. It is so good to see so many of you here at 7 a.m. on the dot. I actually said to Matt earlier, I said, we might just be talking to ourselves, and look at all you bright-eyed and bushy-tailed people. So welcome to the Matterhorn Asset Management sponsored breakfast. My name is Kerry Stevenson, host of Making Money Matter. Today you're going to hear from Matthew Piepenburg. He's a partner at Matterhorn Asset Management, and his title is one that I'm absolutely, I'm very interested about how this is going to play out. The cause and effect of toxic debt, falling currencies, rising gold. Love the rising gold bit. Ladies and gentlemen, please welcome Matt Piepenburg.
Thanks, Gary. All right, can you guys hear me okay? I'm not very technically talented, but hopefully this will work. It's funny that Kerry mentioned the title, because before I left the United States, my colleague and partner Egon von Greyerz said, "It's a pretty boring title, Matt. You know, you're not going to get him with that." And I thought about that in a sense, you know, toxic debt, falling currency, rising gold. It's not very sensational. I don't even have an exclamation point after falling currencies or rising gold. But, you know, in a world or in an industry, certainly in the markets, but in the gold space, we're all kind of maybe sated with hype or sensational kind of clickbait titles to any topic. And when it comes to falling currencies, that's not a very sensational theme. We hear about that on YouTube, or we see it in our white papers or articles. We don't even have in my cover page here anything about some new gold BRICS-backed currency to make the headlines about something that's going to dethrone the dollar or the end of the fiat currency system. But then again, when you talk about falling currencies, we'll get into that this morning, you don't have to worry about some future event. In fact, currencies have been falling, and we'll talk about that for decades right before our eyes. It's basically happening in plain sight. The other thing about rising gold, that also isn't very sensational, not very sexy at first sight, but Matterhorn Asset Management, when it was founded by my colleague Egon von Greyerz decades ago, in that period, gold has outperformed the S&P, and its value has grown by 6 times. So it may not be an exciting topic, but I still think it's quantitatively and quantitatively a rising gold environment. And I think its best days haven't even begun. And we'll talk about that. And yet, despite the performance relative to the S&P when you pick your statistical window, and despite the growth in that asset class, many are saying gold hasn't done anything for me lately, still hasn't done enough. Again, I would argue that compared to SPACs or some crypto story, or maybe even the immortal tech stocks, there is an opportunity cost to gold, and so it still isn't that sensational. And Matterhorn Asset Management itself isn't a very sensational enterprise. We're based out of Zurich. We are the world's largest precious metal storage facility, brokerage facility, transportation facility, outside of the commercial banking system for ultra-high net worth or high net worth clients in the world. Our vault is outside of a fractured banking system for a reason, and our service in many languages for many clients from over 90 countries is, I think, the best in the industry. It's certainly better than holding your precious metals, I think, in a commercial bank, whether that be in Europe or the US. But still, not very sensational. We joke, we have a hole in the ground, we put gold in and it stares back at you. But it's much more than that, obviously. But it's a very simple model, but it's based on a lot of complex thinking and risk thinking that Egon von Greyerz thought of decades ago when he put his own family wealth and the wealth of a small circle of friends into physical precious metals. And decades later, again, we've grown to be the largest service outside of the commercial banks. But again, not a sensational business model despite its complexity, but the truth is, things don't have to be sensational because things are already sensational. Right now, what's happening around us, it's amazing that just this year, it already seems to be forgotten, we had a major banking crisis in the US. 2022, we saw a sovereign bond crisis in the UK gilt markets. That seems to be somewhat forgotten already from the headlines now, as we're all calmly carrying on. US treasuries fell faster than stocks just 2020 during that market crash in 2020 in March, and frankly, if the Fed hadn't printed trillions of dollars at record speed, I think those bond and equity markets would have fallen to the ocean floor. And of course, we had a repo crisis in 2019. So that's fairly sensational on the market level. In the meantime, we have an ongoing war in the Ukraine. Whatever your politics on that, there's an unholy amount of deaths, both on the Russian and Ukrainian side, civilian and military. Kyle Bass is writing articles now about China prepping for war in a nuclear era. That may seem scary. I think it's relatively sensational, but it's a fact. We have a very fractured society, and whatever your politics are, we can't seem to talk about those issues without being labeled as either based, woke, or something in the middle. We have, let's not kid ourselves. Politics are fractured. We have men who put on female swimming suits and go and beat NCAA records, and we are castigated for even questioning the logic of that. Again, open debate, but that's just another symbol of a fractured society. And John Whitehead has been talking about the weaponization of our government agencies. Again, not sensational, as a fact. 1.6 billion hollow point bullets in our government agencies. And I'm not talking about the CIA or the FBI. We're talking about the Department of Agriculture, the Department of Health, the Social Security Administration, Amtrak. It's a surveillance society, not sensational. We all see facial recognition from the airports when we came in here. If you flew overseas, there's a sense of being distrusted immediately. There's a sense of more centralization, more organization. We certainly have a questionable fourth estate or media. It seems to be somewhat co-opted by whatever party has the corporate board that owns that media. So true legacy media has lost a lot of its faith and trust. So, in short, we have a lot of chaos and fracture without even talking about gold or headlines or clickbait or the price of gold or the price of the dollar or where the dollar is going tomorrow. It has to be a story every week. But gold does love chaos and it does love fracturing, and we'll talk about that in a minute. And there's something Rick Rule said about gold, regardless of our views. He was actually talking about silver, but I think it's really true about precious metals in general and gold in particular. He says it rewards infrequently but extravagantly. And I think if that's the case, then that requires patience. And that's a word a lot of us don't want to hear depending on our investment horizon or our time span or our attention span. Patience is one thing. I think it also requires a basic understanding of math and history. And patience, math, and history doesn't sound very exciting either. And we'll talk about that. But I think, is that really a question? Patience, math, and history. Is that iconic? Is that America? Is that really sensational? Is that interesting? And that brings me to the next slide, which is going to start this conversation off. And this is iconic America. This is my America. And I'm an American from a small town in Michigan with a lot of German heritage. Everyone in my yearbook was named Richter or Greendonner or Hoppenbrauers or Faust. Beckman. My name was Piepenburg. I won't get into the whole biography, but I spent time in German schools, and in the summers I would work overseas with that language, but I was American as apple pie, and I played baseball in the United States, and on each side of the infield there was a cornfield. It was right out of, the American image, the cornfields and your feet hanging over a dock, and it was true Americana. And yet, because of work ethic, maybe the Max Weber German work ethic, and because of baseball, I was invited to go play in some fancy schools on the East Coast, starting in boarding school, and then from boarding school in Connecticut to fancy undergrad and fancy graduate schools. I got a very sound education in the Constitution and civics and history and math. And while I was there in those fancy schools with very wealthy roommates, I met my best friend then and now. And I went off to law school, and he was off as an investment banker. And about 10 minutes after passing the bar, he invited me to come out and co-manage a hedge fund. And I didn't hardly know a stock from a bond, and that's the truth. I remember telling my wife, I don't know what I'm doing. She's right there, she'll remember that. And during that time, because of his connections, we had friends at Goldman Sachs. And those friends were able to introduce to what was called a pre-IPO, which in the late 1990s, if you remember, banks or places like Robbie Stevenson's were rolling out IPOs by the hour. We invested in 5 of those IPOs. Again, our idea of due diligence was lunch because Goldman Sachs was doing all the underwriting. So we just went for it. And of those 5 IPOs, 4 were a complete loser, and the 5th was an absolute home run. And It was pretty surreal to be under 30 years old and look at a K-1 statement from Ernst & Young or your broker and see all those zeros. No one feels sorry for that. It's a high-class problem, but my wife, Grazia, and I were sitting at dinner with my best friend then. And if you recall in the NASDAQ, they said a monkey could throw a dart at the NASDAQ. Juniper, Yahoo, Nokia, anyone can make money. Egon jokes that his grandmother was giving investment advice in the late 90s. And yet I looked at our K-1 with my wife and my partner, my business partner, and I said, you know what? Notwithstanding this very lucrative IPO, we have been losing money in the NASDAQ. Everyone's making money. And the idea was we are not very good at this. We are extremely lucky, and we should get out quickly. Fast forward a couple years later, we're barely 30. Again, I've just made more money than my parents, my grandparents, and their grandparents. I didn't earn any of it. It was a lottery ticket. We show up in California with a BMW and a cell phone in each holster, and we buy a house on the beach, and we start doing stupid things like investing in film in Hollywood or in private equity with these projections of this thing called EBITDA. And then we pooled some money with some other families, and we had a multi-family office and a family office, and I was kind of thinking like a lawyer, and we had to, because of this pooled money, we were able to invest in some really great hedge funds all over the world. We were going to London, Chicago, of course, New York. We had a staff of analysts meeting with Millennial and the singers at Elliott and Richard Perry and you name it, credit funds, multi-strat funds. We were paying 2 and 20, and after looking at the private jet my partner bought and the silly investments we were doing in Hollywood, which lost millions, and then looking at running up and down the hill in roller skates, we weren't making money, we were losing money, which means I had to rethink, what am I really doing? What is money? I certainly wasn't making it, we were losing it, and that really goes back to getting back to basic history and math, the things that got me out of Michigan and put me into this silly little world in California and Manhattan and Boston. And so that's what we're going to turn to today, after this long preamble to give you a sense of how I came to gold, having been in the more iconic American dream, the more iconic, sexy story of Wall Street. I got really simple stupid, and I fell in love with gold. And we'll talk about the history and math behind how that makes sense for me, and for probably most of you in this room, it'll be confirmation, but for some of you, maybe it'll be new. Well, this is the iconic America from 1981 to roughly today, that time when I went from being a baseball player in the Midwest to a film investor in Los Angeles, which was absolutely silly. It's pretty simple. In that period, debt has gone up 35x, and tax revenues have gone up only about 8x. So we are basically, as a country, it's a simple, stupid graph, and whether that's Reagan or King Bush the First or Clinton or King Bush the Second or Obama or Trump or Biden, and again, I'm not trying to be flippant, but I don't care what your politics are. We have an open debate, an open question about who really is making decisions in the White House. There's clearly some questionable 25th Amendment issues about the mental ability of this president. I'm not here to make fun of it. I'm just saying, but regardless of your politics and regardless of your favorite or least favorite president, they've all had one thing in common. They love to stay elected, and they get elected by creating more IOUs, which have been paid for by a central bank. So deficit spending is the American story politically in DC. In many ways, like my NASDAQ lottery ticket, we as a country, we're flying on borrowed wings, or as they say in Texas, all hat, no cowboy. We're all debt, no income. And you think about tax revenues, they're down 16% year over year. We need a rising market to cover some capital gains for that. But even tax revenues in a good year are not enough to pay for entitlements. They're not enough to pay for the interest expense alone on our rising government debt, public debt. So that doesn't even get into our military expenses, educational expenses, or frankly, even the infrastructure expenses on the roads that probably brought some of you down here by car. I mean, in New York City, you need a four-wheel drive to get down FDR across the GW Bridge. It's embarrassing. So we are a broke country, and that's not sensational, and that's not hype. It's math. It's simple, basic math. And the same is true of GDP. If I can get there. This is a year-old graph, probably, because it hasn't really changed. It's a simple, very basic principle. This is since 1971, around the time I was born in that small town in Michigan. Debt is up 53 times. GDP is roughly up 20 times. We now have a current debt to GDP ratio, depending on who you read, of at least 120%. We have $95 trillion of combined household, corporate, and government debt. I think that's an abstraction. I don't think it's kind of like Hannah Arendt in her book on the Holocaust, when you're talking about millions of lives. It becomes a banalization of evil. This is a banalization of debt. It's hard to conceptualize what 95 trillion means. Clearly, that's never going to be paid down. Clearly, that's not an exaggeration or hype to say that we're never going to get our fiscal house in order. And there are implications behind that. But any family or business, whether it's small or with a major boardroom in New York or LA or Chicago, if they were looking at a revenue to debt structure like our government does, or other governments in the world, but in particular the home of the world reserve currency, that would be insane. These numbers are insane. So how did we get here? Again, this is going back from cell phones and film deals and Wall Street and hedge funds to basic math and history. How did we get here? This is the stuff I wanted to think about again. And to me, notwithstanding the immaculate conception of the Federal Reserve, conceived in 1910 on Jekyll Island and signed into law in 1913, the big turning points we should keep in mind, some of this may be new to you, some of this may be old hat, but the big key turning points in how America is living as all hat and no cowboy are these four seminal moments, in my opinion, notwithstanding the Fed. The first, of course, is the Bretton Woods promise, up there, the sound money, the top left. You don't need to be a history major to know that America won the Second World War, with the help, incidentally, of Russia. But unlike Russia, we weren't bombed to oblivion. We hadn't lost a large percentage of our male population. We emerged from that war as the world's greatest manufacturer, from Willow Run Airport making B-17s, or out in San Diego making P-38s and making tanks in Detroit. We were the world's manufacturer and creditor. Of course, today we're the world's debtor, and we don't manufacture anything. The American dream is now made in China. But in 1944, we were looking pretty good, and we earned that right. And we had what's called sound money. I say it's like having a chaperone. I have kids. They were pretty good kids. My son a little more crazy than my daughter, but I knew if I left my son home alone without a chaperone, things would get out of hand, like any teenager. Well, it's the same thing with fiscal policy leaders. They need a chaperone, otherwise they'll spend like drunken sailors. And gold, back in 1944, when we decided to be and earn the right of the world reserve currency, gold was that chaperone. But fast forward not that many years later to 1971, again, around the time I was born, and Nixon's in office, and he's looking down the barrel of a re-election. This is pre-Watergate. What better way to get re-elected than to do some spending and not be constrained by that chaperone? In other words, bring in the kegs. Let's bring in the girls, let's have some fun, let's get the parents away and have more fun with this, let's get rid of the chaperone. You take away the gold chaperone, and what does Nixon do? He starts spending and spending and spending, because now there's no one there to control that spending. And you know, Nixon, like every politician, said this is temporary. We're going to go off the gold standard, it's not going to affect the dollar, it's going to be temporary. That's a funny symbol of what we hear all the time from DC. And again, left or right, red or blue, it reminds me a lot of, you know, Janet Yellen saying we may never see another recession in our lifetime. Or in 2019, that same year, Powell saying, you know, there's no reason to think this bull market can't go on indefinitely, perhaps forever. That's absurd to hear from a central banker. Of course, we know a year later the market's dropped by 36%, would have gone to the ocean floor had we not printed all those trillions. Or, of course, Bernanke saying that quantitative easing after the great financial crisis would be very short term. That was when it was just quantitative easing. But then it became QE2 because we had QE1, then QE3, QE4, Operation Twist, Unlimited QE. You could do a whole presentation on the things that our policy-making experts with applied math PhDs from Harvard or Yale or Wharton, all the things they said that were not only just wrong, they were wrong at the time they said it and it was obvious. But that's what we do. We have platitudes replacing or hiding very bad math. So that was a turning point. That was when the dollar lost its chaperone. And we'll talk about the ramifications of that. They're fairly obvious, but the dollar became debased quite quickly. The next big moment after the Nixon Welch was down there and under with a picture there with Clinton around 2000, 2001, when Clinton introduced a bill to allow China and the World Trade Organization. The big story then with this special trade agreement with China is, you know what, this is fantastic for America, is all our toothbrushes, all our computers, our televisions, our widgets, our toasters, they're gonna be buying those in China. What they failed to see is that wasn't what was gonna be happening. They're gonna be making those in China and selling them back to the United States. That too is not sensational. Our CEOs, our companies, some of them who are my clients, made more money by getting cheap labor in China, so everything that we have, the American dream is literally made in China. And we are importing our own goods from China because the labor is cheaper. So we can talk about the Confederacy and slavery and all those bad moments in our history, but effectively we like cheap slave labor in Latin America and Asia because it builds our margins. So that we can't even blame on the politicians entirely, because our CEOs, from our Apple to our Apple iPhones to the grills in our backyard to the tennis shoes on our feet are made at some factory overseas by people much younger than my kids who don't get paid very much. So that was a big turning point. And then, of course, we come to 2022. Oh, this was crazy. Crazy. Again, regardless of your views on this war, we froze the FX reserves of a major power in 2022 for political reasons. We weaponized the world reserve currency. Some could say that's chest puffing. That just proves what we can do. But around that time, in fact, the next day, whether it was Grant Williams, who's an advisor at Matterhorn, whether it's Jim Rickards, who's going to be speaking with me today, and Rick Rule at our conference, at our panel discussion, whether it was my good friend Ronnie Sturfula at Incrementum out in Liechtenstein, or whether it was myself, we all knew, well, this is going to be a problem. This is going to be a big problem for the US dollar. It was so obvious, and none of us got on the phone and called each other to verify it was obvious. It's funny because even John Maynard Keynes says, don't weaponize a world reserve currency. There was an economist who came in front of Congress in the 1960s and said, don't weapon, his name was Robert Triffin, don't weaponize a world reserve currency. And you don't have to go that far back. You can go to 2015 when President Obama was in the White House. He said, don't weaponize a world reserve currency. That will not bode well for the US dollar or the world reserve currency status. So that kind of Hochmut kommt vor der Fall, or hubris comes before the fall. I'm thinking of Condoleezza Rice, 2014. Russia will run out of money before the West runs out of energy. That is arrogant. In fact, it's quantifiably untrue then, and it's certainly proven to be untrue now. And as someone who spends a lot of time in German-speaking countries, I can tell you, Germany was burning coal in 2022 to keep the lights on. And they were buying natural gas from Russia in rubles, and then they were sending money to the Ukraine to beat the Russians. You couldn't make this crazy up. And so de-dollarization was going to become very inevitable. Why? Because the world was going to lose trust. Not just Russia was going to lose trust in the world reserve currency, but everyone, friend and enemy alike of the US dollar. The eyebrow was globally raised. If they can do that to Russia, because this isn't Venezuela or Iran, this is a major nuclear power, a major economic power. If they can do that to Russia, they can ostensibly do that to anyone. And that is the reason we're having these de-dollarization headlines. Well, regardless of whether the BRICS has a gold-backed currency, that's the reason we have these problems. So you've got 41 nations in bilateral trade agreements outside of the US dollar. That's not by accident. This event, this weaponization of the world reserve currency in 2022, again, not very long ago, is sensational all by itself. So what are we going to do? How are we going to solve this? Well, we know how. We solve everything in America. We print money or we expand the money supply. And we'll talk about the M2 money supply and what those implications are, or certainly the Fed balance sheet. M2 money supply, that's kind of a startling chart. It's kind of boring. But I think, as usual, central bankers are always behind the curve. They're always trying too late to do too little when it's not enough. M2 money supply, without getting into the weeds, we don't have time, we can stovepipe each of these topics. M2 money supply is an important indicator. And as you all know, Powell at the Fed is tightening the money supply. He's quantitative tightening. We won't get into all the definitions of that, but the money supply actually has gone down year over year. You could argue he's doing his best to control that horse, put the reins on that horse. What many people don't know is in the last 153 years, anytime year over year money supply goes down by 2% or more, we have a recession. Not an easy one, not a soft one, a hard one. This year, the year over year decline in the money supply is 4%. So if you extrapolate basic math, and if history is any guide and math is of any help, it suggests that we are probably heading towards a recession. So how did this happen? Again, the great Fed magic trick, the Fed balance sheet. Won't get into a long history of how Fed policy works. Many of you are pretty familiar with the basic operations. But basically, our U.S. Treasury issues IOUs for its bar tab of debt. It's for Uncle Sam's bar tab, and they're significant IOUs. The Fed then prints money to buy those IOUs. So we're effectively solving a debt crisis with more debt monetized by money literally out of thin air. Now, even a 10-year-old would probably question that as sound policy. Are these our fiscal warriors, our mental giants, our mathematical geniuses, our MMT authors? Does this seem like the expert work of our best and brightest graduate students? I think I was talking to someone yesterday from Tazewell, Virginia, but from Tazewell, Virginia to Stevensville, Michigan, This is just common sense stupid. We know this is not a sustainable policy for our currency. So where are the voices of reason? Where have they been? Interestingly enough, Ernest Hemingway, someone I spent a lot of time having to read, who used to fly fish up in Michigan, he wasn't an applied mathematician. He wasn't running for office. He certainly wasn't a central bank policymaker. But he's not a happy idiot, with one of the paid groomers to be data-dependent mouthpieces for the U.S. Fed. They're literally kind of groomed through grad school to come into the Fed and drink the Kool-Aid. No, he was just an author, guy with common sense, had some psychological issues, but he's been a couple of times in war. He'd seen the world from the U.S. side, the European side. And what did he say? I think it's worth pausing to read it. The first panacea of a mismanaged nation is inflation of the currency. The second is war. Both bring a temporary prosperity. Both bring permanent ruin. But both are the refuge of political and economic opportunists. Political and economic opportunists. Again, I'm not taking a party stance. That pretty much summarizes what since I look from that list of clowns from Reagan to today, that's what they are. There's not a lot of profiles in courage, as Kennedy wrote about, in the Oval Office or at the central bank, in my humble opinion. So the question is, when Hemingway said that, was he right? Does any of that sound familiar? Well, we'll fast forward. Mouse click money sure brings prosperity. There is no doubt, whether you're serious or jabbling or toe dipping in the markets, that the quantitative easing that began after the great financial crisis has a direct correlation to the production of inflated asset bubbles, stocks and bonds. And that little camel humps in the bottom left there, that dot-com bubbles when I won that lottery ticket. We thought that was crazy, but that was just in tech. And then 2007, 2008, the subprime disaster, that was just in real estate. And then Bernanke, promising that it would be temporary with no threat to the US dollar. It would not disturb the system. Look at the bubble created since then. It's criminal. It's insane. It is certainly temporary prosperity, but we should make another comment here. As a side note, 90% of that wealth up and to the right went to the top 10% of the US population, including guys like me who had contacts at Goldman Sachs to get me into an IPO that I had no idea what it even was. No idea what that company even did. By the way, side note, it had a reverse merger, went to 0 years after the NASDAQ fell. It never made a dime. But we made a lot of money just riding that wave. So in addition to creating temporary prosperity, it didn't really create wealth equality. In fact, it created a dramatic historical level of wealth inequality. And most of us in the room, in fact, all of us who could pay to be here, aren't probably on the sadder side of that wealth inequality story, but it doesn't even help any of us as Americans, as moral people, or even as citizens when there's wealth inequality. Because I'll tell you, what the lessons we learned in Europe, not just in the revolution in Place Concorde in Paris and the guillotine, but wealth inequality leads to social unrest. It's not good for anyone. And we have created, and Bernanke is amazing, he just won a Nobel Prize, and Powell says Fed policy doesn't affect social policy. Bernanke should have got a Nobel Prize for fiction, because Fed policy does affect society, it does affect the wealthy and the poor, it affects everyone in this room, and it creates instability. I'll say, I will talk about some social issues there, but after the prosperity, as Hemingway warned, well, there comes the permanent ruin. Now, we could, again, spend a lot of time on each of these: inflation, currency debasement, and war. Some will say, Matt, inflation's fixed. Look at where it was in June last year and look at where it is now. And we'll talk about that, but more on that later. And as for war, again, I'm from the Midwest. I had friends who joined the Army, joined the Marines. Some of my friends who went to the Naval Academy became Navy SEALs. All of them, without exception, are probably better than anyone I met in Wall Street or private equity. I'll say it. They are literally lions being led by donkeys, and most of them need therapy, and most of them don't know what they were doing in Iraq or Afghanistan. And if you look at the little syllogism, the little list of Operation Freedom and winning hearts and minds, I don't think we won too many hearts and minds in those places. Not, again, the fault of our soldiers. Not that. I'm never saying that. I'll never say it. But Iraq, Libya, Syria, Afghanistan, and now the Ukraine, where the U.S. is using the Ukraine as a battering ram to fight a proxy war with Russia. That's my strong opinion, whatever your views. And there are plenty, I'm sure, that are in favor of this war, but I think the death count right now is becoming questionable. But regardless of that, inflation and currency debasement are consequences. And I think Hemingway was onto something as someone who spent time in a couple world wars, and he's certainly seen inflation and currency and social unrest. So consequences: diluted money, Come on, you don't have to, again, be a mathematician. Keep it simple, stupid. This is not sensational, but fact. Measured against gold, the US dollar has lost 90% of its inherent purchasing power since 1971, since Nixon welched on that chaperone, on that promise to the world in 1944 that we would have a chaperone to our dollar. So no, you know, people would say the dollar's strong, it's relatively strong, and I'm a horse guy. Well, it's strong. It's just strong on a relative basis, but it is still the best horse in the global fiat horse or glue factory. That's all it is. Relatively strong, but inherently weak, the money in your pocket. But that's not all. There's other consequences. You know, Uncle Sam's bar tab, too many IOUs. Anyone who asks for too much money eventually loses friends. They get tired of hearing it. And it's not fable but fact. And it's not sensational in that there's an open reality hiding in plain sight. That since 2014, the world has been dumping Uncle Sam's IOUs and stacking gold. About 444 billion worth of IOUs sold and about 800 billion of gold bought. It's just a simple zig and zag that's not too hard to see. It was embarrassing to even see Yellen in front of the Senate not too long ago. She couldn't even articulate these basic thoughts, these basic debt numbers, this basic mismatch. Former central bank chair and a current U.S. Treasury Secretary, and she doesn't even know the debt numbers as well as most of us in this room. Again, you got to ask, who are these people making these decisions? So, next question, what to do? Shameless self-reference to myself. I'm that handsome guy on the right, but as my son would tell you, I spend more time landing on the ground and falling off that horse than I do chasing that little white ball. But the essential idea of polo is like Wayne Gretzky's definition of hockey. You play where the ball or the puck is going to be 3 moves ahead. And in polo, you can be going full speed in one direction, and there's a little backswing, and you have to turn that horse around right away. And you have to think about turning that horse around right away to get that ball, because it happens in a split second. We're all kind of thinking the ball's where it's going to stay. Everyone's complacent, soft landing, markets are going to go up. We got 7 companies that can lead the NASDAQ and the S&P to nirvana. We're so convinced that be calm, carry on, and platitudes are going to keep us safe because our heads are buried in the sand. No one's preparing for a backswing. No one's going to turn their horse. They're not thinking this way because it's too far away. It's too sensational. It could never happen to the U.S. But, you know, the lesson I'm learning is we need to be thinking straight ahead and then thinking of that backswing. We need to think about the changes that are coming. And so what are the changes that are coming? What is the direction? I'm not here to time it, by the way. I'm just here to think out loud about the directions we're going. They're pretty fairly obvious. The first speaks for itself. While Uncle Sam has been going into debt and issuing increasingly unloved IOUs in U.S. Treasuries and exporting inflation to friends and enemies alike and engaging in proxy wars all over the world and crippling emerging markets with rising rate debt. There's $14 trillion worth of debt that's owed in U.S. dollars outside of the U.S. by countries that can't afford it when they raise the interest rates. That's the MO. So as we're spreading debt and spreading war and spreading platitudes, what's China been doing? China's been building roads, ports, railroads. It's been broken. And again, I'm not talking pro-China. I'm saying let's just look at the facts. It's been building infrastructure in Latin America and Africa. It's been brokering peace between Saudi Arabia and Iran. It built a literal bridge between Iraq and Iran. If you remember the days of Rumsfeld, what did we do between Iraq and Iran? We created a war. We backed one party, the same party we went to war with years later. We have neither friends nor enemies, just interests. And the body count and the cost financially behind our quote-unquote policies is staggering. So, you know, meanwhile, China's doing the Belt and Road Initiative. That's over 150 countries. It's got the Shanghai Cooperation Organization, major power, 40% of the world population and trade. It's getting handshakes from the Crown Prince of Saudi Arabia. Whatever you think of him morally, his role matters. When you call him a pariah state, you get a fist pump. When you cooperate with that party, whether you like him or not, you get a handshake. And we'll talk about the implications of that in a minute. Oh, and by the way, China is winning a trade war. You can't blame that chart, by the way, on Putin or COVID, not this time, because that was already happening prior. Because right now, Putin and COVID give us the excuse for anything that's going wrong. Well, this does, by the way, matter. The BRICS matter. The new direction matters. I'm not, again, saying the dollar is going to be dethroned this year, this week. Not at all. But the BRICS, in a couple of years, if not even this year, their GDP is going to outpace the G7. These backwards banana republics that we've been laughing at for years. And I'm not saying that China doesn't have problems. It has a currency problem itself. The yuan has problems. It has weaknesses. They're headlining this week. It has property price issues. And I don't think the ruble is going to be the world reserve currency anytime in my life or anytime soon in my children's life. But I am saying that Russia and China matter, and these BRICS countries matter, and these alliances matter, and we have to think about this more seriously without getting sensational, without talking about hype about the end of the dollar this week or about a gold-backed currency coming out of the BRICS when we don't even know for sure if that's even on the agenda. I'm pretty sure it isn't. But whether they're members of BRICS or whether they're aligning with BRICS, these countries have 87% of the world population. They're at least having a common enemy in the U.S. or a common enemy in U.S. policy, and they're combining. They don't all get along. They don't all trust each other. But they have a massive amount of influence that's coming. It's not the days of yesterday. We have to take this seriously. And we have to take China seriously. Again, China has plenty of blemishes and problems, and I wouldn't want to live there. I wouldn't want to have a social credit score. I wouldn't want to be locked down without my will. I'm not here to romanticize China, but we have to be realists. The number of countries, the number of, and the growth of the yuan or the renminbi is quantifiably undeniable. So all signs of a gradual move away from the US dollar. And again, this is not overnight. Although the dollar's share of global reserves has fallen from 73% to 58%, can't deny that. That's just a quantifiable fact since 2001. And Brent Johnson has his milkshake theory. He's right. The dollar has massive demand in the euro-dollar markets, massive demand in the derivative markets. It's not going anywhere. Its supremacy is still there. Its unilateral hegemony, though, or unipolar hegemony, is gone. That genie's not coming back in the bottle. Things are going to be very different. They're already very different than they were just a year ago because of that myopic decision to weaponize the world reserve currency. So you don't even need headlines about a BRICS gold-backed currency, which we'll talk about at 11 o'clock today. But one thing that I will say that's kind of sensational, I think the real issue, or the real hidden risk to the US dollar is kind of hiding in plain sight. And again, this is a new direction, and I want to spend a couple minutes on this slide, and I want to be, gosh, I got to move quickly. I want to spend a couple minutes on this slide because it was never a foregone conclusion that the US dollar was going to be the forced currency or the petrodollar. You know, in 1971, when we welched on the gold standard, we needed to have somebody buy those dollars, somebody to absorb those dollars. And it wasn't a coincidence that Kissinger was running around the Middle East trying to make everyone like the US dollar. But OPEC and Saudi Arabia didn't like it. Nobody loved the US dollar. No one liked the US Treasury. So what did our federal chairman at the time, Paul Volcker, do? He raised rates by 15% to make that dollar sexy and more strong. And so, okay, Saudi Arabia says, we'll take that dollar. But now, fast forward today, that dollar and that Treasury aren't loved. And OPEC and Saudi Arabia aren't so interested. And unlike Volcker, Powell can't raise rates by 15% to make that dollar look more sexy. And if you think about it, when Kissinger was going to Iran and Saudi Arabia and the OPEC countries to get them to take on the dollar, and Powell and Volcker was doing that, they were able to help push the oil price up in dollars by 400% in 6 months in the 70s. 400%. That kind of power. But now, China and Russia are thinking, well, China is the biggest importer of oil and energy, and Russia is one of the largest exporters of oil and energy. Now China, rather than the US, has interests, and Russia has interests in meeting with Saudi Arabia and OPEC and thinking maybe the dollar isn't the best choice for the energy price. Maybe that's why Biden is getting a fist bump and Xi is getting a handshake. Because, and I'm not predicting this is going to happen overnight, but if you see a shift in the petrodollar, that's going to be far, even if it's a partial shift, that's going to be far, far more significant than a gold-backed currency among the BRICS nations, in my opinion. So the other new direction we're going into, I'm going to move quickly because I got about 5 or 6 minutes here, I'm sorry. You know, you raise rates, you break things. It's very simple. You raise rates, you break things. We had a UK banking crisis when interest rates up. We had a dot-com crisis that blew up when we raised rates. We had an emerging debt crisis that broke up. And now we have rising rates that are clipping the wings of the so-called recovery in the US. I mean, the system is very simple. We live on debt. When you raise the cost of that debt, those wings get clipped, and our system and our economy starts to reel. Things have been breaking. Again, we'll go really quickly. We saw, as I introduced earlier, the 2019 repo crisis, the 2020 COVID crisis when stocks and bonds fell dramatically. 2019, the too big to fail banks didn't trust each other at all. Those are up-o events. You had the gilt implosion in the UK. You had Silicon Valley Bank. We could spend a whole session just on the banking risks right now. You could spend a session on each of these things. And so they're breaking. What's the problem with singular focus? Well, it's what Lou Groman says, the lack of second derivative thinking, a lack of complex thinking. You can beat inflation by crushing the consumer. You can do that. You know, when Napoleon marched into Russia, he had 422,000 men in the Grande Armée. A year later, 10,000 crawled out of Russia. That's the problem of singular focus. Got to get 2% target inflation. Again, you can get it by crushing the economy, crushing consumer demand, crushing the middle class. It's hardly heroic, but it works. By the way, 70% of our GDP, though, is consumer demand. So be careful what you ask for. Again, in other words, there's a price to victory at any cost. And I think Powell, with his data-dependent reasoning and his cush job and his yes-saying attitude, he's a total Ja-Sager, we say in German. It's kind of like click your heels and do what we're supposed to do to make the story look good when the math is really, really bad. So now, new direction, bubble assets, rising rates, that does break things too. Last year, worst nominal returns in stocks and bonds since 1871 after the U.S. Civil War. That's not sensational, that's not fable, that's fact. You'd say, well, Matt, S&P's ripping, NASDAQ's ripping. Yes, two things to think about. What is the S&P 500? It's 7 companies, 7 names. The rest of the stock market's a laughing joke. It's full of zombie companies that can't roll over debt at a higher rate. We could spend a whole day just on that. And the other fact of the matter is good news and bad news. Well, bad news is good news now. Throughout 2023, markets are waiting for the Fed to pivot. The Eurodollar futures, the contango in the futures market, the experts, the FX jocks, the COMEX traders in Chicago, they're not looking at bricks and this and that. They're looking at trends, they're looking at debt, and they're looking at yield curves. And they're saying, Powell's going to pause and he's going to pivot. That means more pathetic, desperate liquidity. That means a tailwind for the U.S. markets. So they're agnostic whether that's good or bad for the inflation or good or bad for the dollar in your wallet. So, you know, things break. And then comes the layoffs. Layoffs, we could spend another time. Nick Eberstadt, jobless claims. I have joked about the Bureau of Labor Statistics and the creative writers, or whether it's on inflation or job claims. Again, could spend a whole hour on this. We're seeing layoffs at the big companies. It's not making the news. One of the things I think is most fascinating in America, which is kind of like Pravda in the 1950s in the Soviet Union, is what they're not talking about, what they're not going deeper into. That's not a conspiracy theory. It's what I would do if I didn't want people to know what I was doing. I just wouldn't talk about it. The things that are embarrassing, let's keep that out of the road. And again, I could spend a long time just on the labor markets. So what are we going to do? What are our options? Continue to raise rates into an historic debt bubble? You know, that bar tab is getting bigger and bigger every year, and that interest expense is getting more and more expensive. How are we going to pay for it? You know, the money's got to come from somewhere, and there's going to have to be a choice made. That red line on the top, you know, is the federal surplus deficit, and then the blue line is the number, the foreign international, excuse me, I got to confuse the blue and the red line is the gap between foreign owners and U.S. treasuries and our current deficit. That gap is as big as the deficit was, or that gap is as big as it was during the COVID crisis in 2020. If you remember, we had to print trillions and trillions in a matter of 12 months just to fill that gap. And that was extremely detrimental to the U.S. dollar. What are we going to do now? There's going to have to be a choice. And the choice is, do we save the system by printing trillions more to buoy up the market and fill that gap, or do we let it die and save the currency? Well, history makes it pretty obvious what the option is going to be. Throughout history, without exception, the answer is always kill the currency to save the system. There is literally no empire nation in the history of economics or politics in which that wasn't the choice. You always know that the currency is the last bubble to pop. This is not sensationalism. The other thing I'll say real briefly, the more dangerous thing is whenever you have a debt crisis, whether it's ancient Rome, the Ming Dynasty, Chairman Mao, Latin America regime change, fascists in Spain, Italy, Weimar, whenever throughout history you have a debt crisis, you have a currency crisis, you have a social crisis, and that social crisis is always addressed by an extreme centralized control from either the political left or the political right, every time. We could spend a whole day just talking about the many examples of how that control is rising in the US and Europe. So you could say, but come on, you know, Rome's not going to fall. We're the world reserve currency. This can't happen to the US. And it's true, in all fairness, it's a lot harder to kill a world reserve currency than to kill the currency of a banana republic or a fringe nation. But, you know, since we solved the debt ceiling crisis, we've already spent $800 billion that we don't have. The current White House, you know, I'm not picking on Biden. It would be the same if there was a red or blue president. It's $500 billion a month, basically on average. And combined corporate household and public debt, again, climbing above $95 trillion. Rome doesn't burn in a day, but we've been burning for decades. And I do not know, and don't ask me because no one knows what will be the next trigger or the next event. It's not going to be a BRICS currency next month. It could be something in the petrodollar area, but I can't time it. No one can. Anyone who tells you they do know is not being honest. But we do have to make a choice, and this is something I'll move quickly through. This is something, we have a choice who we're going to trust. Are we going to trust the experts? Well, I'll read this real quickly. You have to choose between trusting the natural stability of gold and the natural stability of the honesty and intelligence of the members of the government. And with due respect to these gentlemen, I advise you, as long as the capitalist system lasts, to vote for gold. So there we have it. Do we trust gold or do we trust this guy? Well, the polls aren't trusting him. I don't trust the things he said because I've verified, trust but verify. But if you verify the policies, I think the decision's fairly easy. You know, there's a reason the BRICS are stacking gold. They trust that more than they trust each other. They trust that more than they trust the US dollar. Central banks are stacking gold at historical levels. Now, what's interesting is why does the US suddenly not talk about gold in the headlines? They just don't do it. It's interesting. They did in the past when it's falling or when the S&P is ripping. But when gold is rising or holding its own, there's a deliberate desire to downplay it. Again, lies of omission. This is what the spooks and the intel agencies have been doing for years in every country in Europe and the West. Omit, lies by omission. Don't talk about the gold price or make fun of it as a pet rock. If it's a pet rock, why are central banks buying pet rocks and not Bitcoin? And I'm not against Bitcoin. I'm just saying, why are they doing that at record levels? And how long can they keep doing this? Well, the answer is simple. Gold is embarrassing to fiat currencies that are fantasy money, that are backed by nothing but the full faith and credit of experts who aren't experts and politicians who have more interest in being reelected than in representing their constituents. I don't think that's an exaggeration, regardless of your politics. It's basic history and math. Gold is embarrassing to fiat money. And again, not going to spend a lot of time, gold, that pet rock, it's really simple. Over a century ago, long before today, if you wanted to buy, if you had $1,000, it would buy you 48 ounces of gold. Today, that'll buy you less than a half of an ounce. Is that really not very sensational? Is that not doing enough for you when people talk about their SPACs or their S&P or their manager or this hedge fund they found? I'd looked at a lot of hedge funds. I invested a lot of money in hedge funds. At the end of the day, they barely broke even when you look at all the expenses. And there's a few guys who could look at Keltner bands and Bollinger bands and DMARC indicators and play the vol. I'm not one of them. And even the guys that are good at it aren't good at it year after year after year. And if they are good at it year after year after year, there's probably something wrong. My point is, gold isn't very sexy. Going back to my original point, gold is not sexy, but it's really smart. If you're interested in wealth preservation and you're not the guy I was in LA chasing film producers in a BMW like an idiot. That's what I was. And then, thank God, I started thinking about this before it was a little too late. I'm not here to poo-poo speculation. Speculation can give you risk and reward. But hard work, common sense, basic history, basic math, the things I knew in Stevensville, Michigan, and forgot in LA and New York, matter to me now more than ever because I'm in my 50s, I have a family, I still have a lot to do to take care of them. We've got a lot of things around us coming at us. That's not sensational. Gold is breaking technological and psychological. We could again spend time on this. Gold is not going to go up in a straight line. There will be pullbacks. There will be. I don't know when they're going to come, and maybe there won't be. It doesn't matter. None of our clients in Switzerland, our minimums are $400,000 for our vault in Singapore and in Zurich, and $5 million for our vault in the Swiss Alps, which is literally something you got to see to believe it is out of a James Bond movie. It's the safest vault in the world. It's outside of the banking system. We don't trust the banking system. We don't trust the privacy laws in most of the countries, including the U.S. Switzerland isn't perfect, but it's better than anyone else, and that's not a conviction bias. It's a conviction. And we look at all the jurisdictions. But most people, and we have clients from 90 countries, don't want to hold their gold in their own because they don't trust their own governments. But it's broken a marginal line in technicals in the 1350 a few years back. It's now broke 1950. It's now a floor, not a ceiling. It will be volatility in the gold price. There will be headline moves. There will be manipulation in the comics. There will be spoofing. But there is deleverage in the derivative markets. There is naked shorts going on in the gold and silver prices. There are drive-by shootings in the silver markets and the COMEX. There are. It's an open secret. But they're running out of supply and demand to make that possible. They're running out of leverage to make that spend. I do not know when the bell will toll for COMEX and LBNA manipulation, but it's coming. And meanwhile, Moscow World Standard isn't a coincidence. They're looking for fair ways to create and price exchange of physical gold. But our solution, again, very simple. Egon founded Matterhorn Asset Management for his own money. He eats his own cooking. It's like that Bosley commercial. I'm a hair club member because I'm not only its founder, I'm its member. Well, Egon is a founder and a member. A great deal of his own wealth is in his own cooking, He was thinking, how do I solve this problem? I've got money. How do I protect it? Not how do I grow it and make film deals in LA. How do I protect the wealth for generations? What's the asset? Where do I put that gold? What country, what jurisdiction, under what laws? Do I put it in a bank, in a safe deposit box, under my bed? He was thinking about this decades ago. Very simple, but very complex arrangements were made. He was way ahead. Again, the most secure vault in the world. Other central banks would envy our vault. Other national banks would envy our vault. And of course, if we have a mushroom cloud, Armageddon, banks fail, it's not easy to get gold from Switzerland to the US. We've thought about that. We'll talk about that. It's not easy to reach us. It's not easy to transact with banks if they're not there. We've thought about that. Again, I can spend hours just on the operational sophistication of what Egon put up with or thought about decades ago. There really is, and the reason I became a partner rather than an investor is I think what Egon is doing is moral, financial, simple. It's not sensational. That's our team. That's where you can find us at goldswitzerland.com. Those are my partners, Johnny and Nicholas. We have a fantastic staff of people behind the camera and behind the desks who speak many languages. We all speak many languages. We have clients from all over. And we welcome you if you want to give us a call or come to Zurich or send us a Zoom or an email. We'll be happy to meet with you and take you to our vaults. And that's a book that Egon and I wrote called Gold Matters. If you want to get a little more deeper dive into the themes that I'm talking about today, Egon and I wrote that last year. It covers the broad swath of math and history and common sense. And I thank you, and I'm sorry I've gone over. I don't even know if I have a time for a question. I really apologize, but that's my presentation for today. Thanks.
Not redeemed for gold. How will it displace the U.S. dollar in a fiat competition over gold?
Great. Well, so he's asking about what is the real, if the BRICS makes a trading currency, not a sovereign currency, but a trading currency backed by gold, how would that dethrone the dollar? Because,
No.
Oh, okay. Okay.
The question is if it makes it, but it's only redeemable between nations.
Right.
You and me take it in. And
Exactly.
17 gold dollars in change for a $20 bill.
So it's only redeemable between nations, not between citizens. You can't go to the Russian central bank or the South American central bank and redeem that trading currency for physical gold. Well, that's true. That's really what it is, isn't it? This isn't a sovereign currency, it's a trading currency. But the bigger question, I think, is even if you were South Africa and you had a trade agreement with Russia as a BRICS member and you wanted to redeem your gold with the Russian central bank, how could they do that? What if Russia isn't so friendly 5 years from now? But the point is that really a threat then to the US dollar?
Is it any better than a fiat head-to-head competition?
Short answer is I don't think it's a real threat to the US dollar. I think the real threat to the US dollar comes within the US, not outside the US. The real threat to the US dollar is Bernanke, Powell, Yellen, President X, Y, or Z, Congressman, Senator X, Y, and Z, who wants to get reelected by spending more than we earn. You know, I used to joke my son would be the most popular kid in the frat house if he could use my credit card to buy everyone everything they wanted. Who wouldn't love him? You know, my daughter would be real popular, look real successful. She put mom's credit card and bought a Ferrari. But that's not success, that's debt. That's faking it. And so the real threat to the US dollar has been happening right in front of our eyes since 1971. 98% of the inherent purchasing power. That is the key, simple, stupid answer, in my opinion. It has nothing to do with the relative strength of the dollar. Of course it's important, the DXY, all these things. But the bottom line is you're losing money in your wallet, your portfolio, and your checking account every day. It's an invisible tax. You, by the way, can afford it more than the average American whose median income is $40,000 to $50,000 with children and mortgages and car payments that are defaulting like mad right now as we sit in Boca Raton or I sit in the south of France playing frickin' polo. You gotta be aware of this. You gotta remember, I'm still from Michigan. I'm still that guy whose mom was a secretary. It bothers me. It does. Anyway, I don't want to get emotional.
It bother all of us, and I think this is it was a fantastic presentation.
Okay.
Nancy, thank you very much.
Thanks.